Galaxy Surfactants is in focus, and we're now joined by Natarajan, who's the Managing Director of the company. Hi, Mr. Natarajan. Good morning. Thank you very much for taking the time out to talk to us. I want to start with what's happening in the industry, what's happening in the company. At your last con call, you indicated that you were expecting late single-digit volume growth. And of course, in terms of the numbers that we've seen, there are early signs that volume growth is showing signs of improvement. I know we are ahead of earnings season, so it'd be tough for you to call it, but give me a sense of where things stand.
Thank you and very good morning. Thank you for having me on the show. Yeah, so as I had said in the last quarter's earnings call, the demand side is improving, and then we see the momentum being there. But the issue that I'd like to bring to the attention is the supply side has been having challenges in terms of the logistics. Internal logistics has worsened over the last 6 to 8 weeks. The team is working out ways to ensure that we are able to keep our customers served well. So that's been one of the challenges that has emerged over the last 6 to 8 weeks. But yes, we are working around to ensure that we manage that well to serve the demand side.
I want to talk to you about the supply side logistic concerns and if there are delays on that one. But just before I go into it, we believe, and we've seen this in data, right? Inflation is easing in markets like Europe and the US. I believe there is some destocking that's currently underway as well. Do you feel like in terms of your top line, premium products are also seeing a pickup, and hence markets in Europe and US could grow significantly in the calendar year?
Oh yeah, so we are seeing some early green shots. We saw that in the last quarter of the previous financial year. But then we need to wait for 2 more quarters to see as to how it sustains. But the destocking mercifully seems to have bottomed out, and we do see customers starting up on projects that they had kept on hold in terms of premium specialty inclusions in the product. So we need to wait and watch over the next 2 quarters, but the early signs are looking good.
You mentioned there are supply side logistic concerns that the company is facing. You want to elaborate on that? Tell us what those concerns are and what is the impact of that? Is that leading to a delay in shipments and hence orders are more lumpy in nature, or deliveries in that sense are more lumpy in nature? Give me a sense of what's happening on ground.
Yeah, so this what we are facing now is probably things coming a full circle post the Red Sea attacks by the Houthi militants last November. The shipping company is deciding to skip the Suez Canal and go to the Cape of Good Hope. Has come to a situation where you have ships taking a longer time to reach the destination, containers getting stuck midway in the sea for a longer time. And now we have a situation where you have congestions in ports across Asia. You look at China, you look at Thailand, you look at Malaysia, Singapore, and even now Shiva in India. So the 2 issues. One is the incoming feedstocks also getting impacted. You're talking about something like 3 to 4 weeks delay. You also have outgoing shipments, slots not being available when we need it. So it's something where we have to manage both the incoming and the outgoing. But we are now adjusting to the new normal, and the team is finding ways to ensure that we are able to serve our customers well despite this challenging logistics scenario.
Fortunate, right, Mr. Natarajan, because the last couple of years, the industry has struggled on the demand front and now, of course, dealing with supply concerns. I really hope that that sort of plays out okay. Sooner the better. But supply concerns because of Red Sea, now does that also increase? I'm assuming there's a delay in delivery, but does it impact the cost of delivery as well, which then of course means that margins are getting compromised?
So first is, let me come to the cost. The cost certainly, your shipping rates have gone up almost 3 or 4 times, and that's something that was even there when I spoke in the last earnings call. The margin impact, obviously, because you do pass on these increases with a lag, but that's less of an issue. But what is more critical is our ability to serve our customers well, ensuring that we are able to get our production runs done uninterrupted. So it's more about managing this particular scenario because that's the first priority, to ensure that we are able to serve our customers well. How do we manage the shipments, both incoming and outgoing, despite all these constraints to deliver on time. So that's what the clear focus is. The margin impact because of this increase in freight rate is something that would get taken care of.
In that case, increasing stocking, is that an option? And if yes, then is it a fair assumption that in the next couple of weeks, these problems will be resolved by your team and will be behind us? So there's no stress, I'm assuming, in terms of your clients putting pressure on you, right? While they're disappointed, I'm guessing, but no worries in terms of loss of revenue from them at this stage.
No, that's not the case because the customers also understand. So in fact, we are trying our best and the customers are pretty happy the way we are serving them. So that's not an issue. But then you need to manage this new normal and then get your stock levels and your shipment schedules adjusted appropriately. Also manage the freight rates well in dialogue with our strategic logistics partners. So that's something that my team is doing a great job. But yes, there is obviously no concern on the revenue side. It's only in terms of managing this interim till the time we are adjusting to the new normal. As regards the situation coming to normal, it probably would take another 3 months. That's what we read in the various press reports.
Oh, fingers crossed. Hopefully things don't escalate geopolitically in the next couple of months. Then if everything goes as planned, one more quarter out is when the situation should normalize. Let's talk about margins because brokerages believe that while there is going to be 7 to 8% volume growth coming from you, there's also an expectation that margins are going to expand significantly. And I want to ask you specifically about verticals that contribute well. So specialty care revenue contributes 41% to your top line, and it's a high margin business. You want to take me through where blended margins stand and where do you look to taking them out in the next couple of quarters?
So we had said in the last earnings call that we're guiding to a 6 to 8% volume growth, and we did revise our EBITDA per metric ton upwards to a band of 20,500 to 21,500 rupees per metric ton. This essentially we also explained would be in terms of what we see as the premium specialties gaining traction in the developed markets of US and the Europe and some parts of Asia Pacific, that's Japan and Korea. And that's something is what I said even in the starting at the start of this call that we are seeing some early signs and we would want this to sustain. And that is what is going to be giving us the ability to enhance our margins.
Operating expenses, sir, those were on the higher side due to higher power, higher fuel cost, and I don't think that's coming off anytime soon either. We've also mentioned freight costs that gets passed on, but concerns on the other front, or those also are pass-through expenses?
Oh yeah, so that's something that gets adjusted because the cost side, obviously we need to manage it well, but whatever increases that are unavoidable are something that gets passed on. But they all happen with a lag, but that's been the case over the last so many years. So that's not an issue. It's only when you have something going up significantly in a quarter without much of an advance notice, then you need to adjust with a lag. Otherwise, this is something that we have been used to in terms of managing the cost side well.
So where do you see your EBITDA margins at in the next few quarters, in the 12-13% range, or there is a likelihood of that moving upward? Because all the way back in a couple of years ago, your margins were upward of 13-14.
Oh yeah, so I would like to, we had a silent period, so I would like to stick to the guidance that we gave in the last earnings call of a 6 to 8% volume growth and EBITDA per metric ton in the range of 20,500 to 21,500 rupees per metric ton. So that's what I'd like to say as of today.
You maintained that from the start to end of last quarter and up until now, you've maintained that the industry is seeing early green shoots. Globally as well, the situation has improved with inflation easing, premium products are seeing a pickup. But any more early signs that you're picking up on that could mean that not just for you, but the whole industry might be seeing a revival on the supply, on the demand side?
Well, I'd say because I think last year was pretty bad for the entire industry. I think with the green shoots that we are seeing, it would augur well for this entire specialty chemicals industry, the way I see it.
So, just a quick one. I do believe that you talked about new product launches. Those are still on the anvil, or with everything that's happening in terms of supply disruption, new product launches are on a pause for now?
No, new product launches, we are keeping up the momentum. In fact, we launched one in the last show in cosmetics in April. We also got the silver award for that in terms of the innovation quotient. And that's something that we have launched well, and we do have some more in the pipeline. So that is not something that we are letting down on speed and agility. So that we'll continue to do. These supply side disruptions are temporary, and we would need to manage them, and we're managing them well.
Sir, so also you've earmarked expansion, about 150 crores of expansion plans. These are all going to go towards new product launches over the next couple of quarters. And also, are these products got a larger market or are they better margins in that sense?
I said the specialty products that we're launching essentially are for niche markets into niche applications. So that's the way these premium specialties are. With regard to our capex, we will obviously be doing about 150 crores this year, and it is a mix of what we do on expansions on our performance surfactants as well as specialty ingredients, and that's something we'll start reflecting in the coming years in terms of revenues and margins.
Hi, Mr. Natarajan, lovely chatting with you. We hopefully will see you post you report earnings and we're out of that silent period. We'd love to know what those numbers actually look like, but good luck until then, and we'll catch you soon.